Welcome back to our monthly Market Outlook webinar series, where we will be providing a comprehensive perspective on markets and investment strategies. We have with us Mr. Aman Chauhan, who is the Senior Fund Manager at Abacus. He is currently serving as the fund manager and with over 17 years of experience in the investment industry. Before joining Abacus, Aman managed local and offshore portfolios at Reliance Asset Management. He also holds an MBA in finance from KJ Somaya Management Institute and a bachelor's degree in commerce from Mitibai College. We request your kind attention during the call and would encourage you to have your questions ready for an engaging and insightful session. Now I request Aman sir to please proceed. Over to you, Aman sir.
Sure. Thanks, and good evening, everyone. And sorry again for the delay. And this is Aman, and we'll be broadly taking you through as to what the market outlook is in the month of August and how the market looks ahead for us. As we have been discussing in the past, what we feel is very clear that the risk to the market is more local, less local, and it's more global in nature. Locally, as we have been discussing with you guys, we feel that the economy activity has picked up. There was a slowdown in the year 2025. The second quarter GDP of last year was 5.5, which is a seven-quarter low. And post that, things have picked up. And as we speak, the momentum in the economy is sustained. Just recently, we had the announcement coming on the GST front, which clearly indicates that the government is looking to further put emphasis on the consumption, which is being slowing out. There is a lack of acceleration in the consumption growth in India, and rationalizing of GST, which indirectly also means that the GST rates will reduce, is something which the government is looking at to further increase the velocity of demand or further increase the consumption in India. And this bodes well. Uh, I clearly recall a few months back when we had a similar session, and I had messaged or we had discussed this that the measures that the government has taken so far, which is in the form of tax breaks in the budget and then the RBI action that has come in, that was clearly indicated to us as something which is round one. And the government was very clear that if the round one is insufficient, then they're okay to consider round two also. And looks like the GST is something which is round two of the action for them. The government cannot completely exhaust all its options in the first go itself. It's like you are fighting a war and you can't exhaust all your bullets on the first day itself. Then what will you do on the second day? Same way, because of the global tariff uncertainty, the Indian government has taken steps uh, gradually. So you had your first step of budget, then you had the RBI, and now the GST. So it looks like the government is pretty clear on the intention that the growth rate in India has to accelerate, and that is what the clear focus is, and which is something which is very positive, both for the economy and eventually for the equity market also, because this clearly shows the intention of the government. So it is no longer a hope theory that Indian markets or Indian economy will recover. It's clearly recovering. This is what the data point is already suggesting us. And on top of that, the intention of the government is also pretty clear. So it's no longer a hope that the government needs to do something and something has to happen. It's high time, nothing like that. We have taken the action is required. So now what is the issue? The issue is towards tariff. And the tariff is something that we have been discussing since more than 6 months now. And that is where the major uncertainty even today unfortunately lies. We thought by now things would have got stabilized, or you can say the tariff issue would have got closed. In fact, earlier during the month, there was expectation that around this weekend, the US delegation would be visiting India, and that would pave way for the final round of negotiations before which the announcements can happen. But unfortunately, it looks like there's some delay there. Or that Trump has tweaked of the 25% tariff and then doubling it to 50. Market has not even blinked an eyelid to that. And then it's not just India. Globally, markets have not been responding or reacting to the Trump tweets on tariff because they all now realize that it's more of negotiation than anything else. Unless and until there is something which is concrete and something which gets signed, the market is not going to worry about the tariff scenario. And that is what the scenario here is. If I have to look at the recent performance of the markets, you will see on your screen that in the past 3 months, most of the regional as well as the global markets have bounced back. India has also bounced back, but relatively, we are much way off than what it was. So this is, you can say, a far change than what used to be in the past, where India, both on an absolute as well as on a relative basis, used to outperform. So while we are positive in the last 3 months, but nothing much has moved on the Nifty index front the way other markets have performed. Other markets have performed mainly in double digits, while the Indian market is in the low single digit. The reason for that is that Indian markets have already done well in the past. So we are taking a breather kind of a thing instead of having a sharp recovery, where the other market seems to be still in the recovery phase. So they had a sharp fall, they took a breather and then started to recover. India market had seen a very sharp recovery starting April onwards, where we are back to 24,000 Nifty, which is closer to the earlier high. And that's the reason, probably one of the reasons why we feel that the Indian markets have done well, but relatively still it's not one of the best performing markets the way it used to be. There's also this phenomenon which people feel that there's too much of supply, IPO coming in, QIPs, private equity sellers, promoters which are paying the stake, which is absorbing the liquidity which is coming in. If that wouldn't have been the case, then the liquidity that comes in could have taken the market higher. Partially, it is true that yes, the liquidity is getting absorbed or the demand is getting absorbed, but I feel that's not one of the major reasons, because at any given point of time in the bull market, there will be enough of supply, there will be enough of you can say fundraise, QIPs, and so forth. But that's the feature of the bull market. Every bull market has this phenomenon, nothing different. That maybe in the near term, maybe in a month or so, or maybe in 2 months, where the number is pretty high, this could be an impact, but not on a sustainable basis. So this is something that we are not overly worried about. Uh, if when we do this call again, say after 2 3 months, I believe this slide would change. The performance of India would have been improving, and instead of being at the bottom right now, I think next time this will be at least above average, or we will be almost against the better performing markets as we speak. uh, so now globally, tariff is a worry. What is a worry on India? The India is that the Trump has said that it's going to be 50% tariff. How is going to impact us? I don't think that is going to be any meaningful impact. Don't get me wrong, there is going to be an impact, but not a meaningful impact is what I say. We have roughly 70 billion dollars of trade with US, and out of which you can say almost 30-40% of that is basically electronics, which is exempt right now, and pharmaceuticals, where we don't feel that the tariff is going to be pretty high. Trump has been pretty vocal. He has tweeted many times specifically on pharma tariff, but we feel unlikely that the tariff on pharma is going to be high. How can you justify a US citizen that the iPhone that they import and use, there is going to be a tariff exemption? So your iPhone price is not going to go up, but your medicine price is going to go up because the government wants to put a tariff on your medicine that you're consuming. Right? Very difficult. The iPhone is going to be the same, but your medicine is going to get expensive. And hence we feel that it is very unlikely that the is going to be a very abnormal, a very high tariff on pharmaceutical. And hence we feel, plus there is pricing power with these companies. Nobody in this world, if they can afford a medicine, will stop taking medicine just because it's got expensive, just because there's a tariff on that medicine. Yeah, if you can't afford, then you can't afford. You can't do anything about that. But if you can afford, you will definitely pay the price to get the medicine, right? So in that way, it is inelastic to a certain extent. And hence we feel whatever tariffs comes on the pharma also will get easily passed on. And hence we are not too worried per se with regards to what the eventual tariff is going to be. But having said that, this tariff is going to impact somewhere or the other, and maybe that is something what is getting reflected in the currency also. If you see the latest currency, especially in the last month and a half, what has happened is that INR has depreciated. If you see that slide here on the left hand side, you see there is a sharp depreciation of INR. Now, this INR depreciation has been in line with many of the regional players, but the larger currencies, especially the Chinese currency, has not devalued the way the Indian currency has devalued. Right? This to me looks like that the RBI has allowed the rupee to depreciate, because the dollar index is where it is. It is still at 98 levels. It is still below 100. So it is not that the dollar is appreciated. A few months back, when rupee had 87, 88 levels, it was predominantly because of dollar. The dollar has very sharply rallied. This time around, dollar has not rallied. Still, the INR has depreciated. This is more to do with specific INR depreciation. And it looks like a competitive depreciation by the government or by the RBI, whichever way you look at it. And looks like this is the way government wants to compensate the exporters. So government is very clear that looks like during the negotiations with US, maybe the final tariff which they are negotiating or trying to finalize on is higher than what your initial thought process was. Initially, if the Indian government felt that the US government will have a 5 or 10% tariff, maybe now it is sensing that it is not 5 or 10, it could be 10 or 15. And hence, you need to compensate for the exporters for that additional levy or the tariff that is going to come on them so that they are competitive enough in the global trade and in the global scenario. And the market share gains that Indian companies are having with China continues. And that is the reason it looks like the INR has been allowed to depreciate. So to me, this looks like a precursor to the tariff scenario. And this in the near term could be a real risk to the markets. Because what can happen is if the rupee continues to depreciate. Today it hit 88, right now it is around 87. If this has to go to 89, 90 levels, then during that phase of time, the foreign money gets interrupted because no foreigner would like to invest into a currency which is depreciating. You invested into India at 95 level, 95 become 98, 98 becomes something else, then you lose that much of value of a portfolio. So people tend to shy away to invest into a depreciating currency. If the INR depreciate because the dollar depreciate, then also globally liquidity will move to a dollar asset than to INR asset because there you tend to make slightly more return. You invest into a dollar at 90 levels, it became 95, you make that additional 5%. And hence people would prefer to be in a dollar asset. So this in the near term can impact the FI inflows into India, and this could be a real dampener. Something that we have seen in the month of July when you can say uh, the real move in the currency happened. Prior to that, we have seen decent FI inflows into India, especially in the month of March, April, May, June. July, in a way, has seen a reversal of that. If this depreciation fear, even if the rupee doesn't depreciate, but if the fear of depreciation stays, then this number can stay negative or maybe neutral. And that, to me, is the near-term risk. The other major risk could be if the tariff seems to be substantially higher. So if Trump insists that India has a 25% tariff and the region or the peer group, say our neighbors, Pakistan, Bangladesh, Philippines, Taiwan, China, and maybe even China, if they have a 20% tariff and we have a 25% tariff on an example, then Indian markets will definitely derate because this is making us definitely uncompetitive or less competitive versus our peers, and this is going to have an impact. The chance of this happening seems to be pretty low. It's not that we have fallen apart with US or we are not in good terms with that. Hence, I feel it is very unlikely this can happen. But Trump being Trump, anything is possible. At least on the Twitter front, before it happens or no, but at least he can keep on tweeting on this, and this can be a near-term risk because uh, the whole premium in India, people are paying a premium to invest in India. We are paying a premium to invest in India. Is happening because globally investors feel that the China plus one strategy of get moving away or reducing the dependence on China manufacturing and moving to other countries is something which is very beneficial for India. India stands a very good chance to gain market share, and hence people are investing into India. Plus the government policies, Make in India, Atmanirbhar Bharat, what Modi is doing, the GST reform that he is now talking about, and so forth, which is all going to add up to the domestic demand. So these are the reasons why people are investing in India. And if there is a derailment of that global China plus one story, then Indian markets can derate. We can correct back to 2021, 22 levels if this happens. But right now, I feel the probability or the chance of this happening is pretty low. So the outlook remains that in the next month or so, we feel the proper clarity on tariffs should come in. And once that happens, the markets will decide as to at what level it should stabilize. If the tariff number is higher, then it can stabilize 10% lower. If the tariff number is in line, it can consolidate or it can stabilize at these levels. Ultimately, once this is behind us, people will start to look at equities. People will start to look at the Indian economy from a very fresh perspective. And that fresh perspective comes at how is India relatively placed versus the other economies. And here, I feel we are decently well placed, especially considering the way the global scenario is where everybody is putting, you can say, counter tariff, or everybody's putting a defensive tariff. Everybody's putting tariffs to protect the homegrown industry or the domestic industry. So in that protectionist environment, I feel India can do well because India uh, growth is not dependent on global demand. So while people will prefer to make their own rather than import, but so be it. Other countries will be more affected because they are more export dependent than what India is. And that's the way relatively we are better off. The other positives in India, we all know about the demographics and under penetration and improving their lifestyle and the developing nation becoming a developed nation and so forth. So no point repeating and debating over that. We all know about it. The main point is that Indian markets should do well once the global uncertainty is behind us, which we feel should it's due this month, if not this month, hopefully next month. By September or onwards, we feel that clarity should come in. So this is where we are standing today, and keeping this in mind, we are while constructing the market, we are not very aggressive. We are not going overbid trying to invest in the market or deploy capital. We are gradually deploying capital because the view remains positive over a 3 to 5 year window. But in the near term, since there is global uncertainty for which I don't have any control, there is nothing that I can do. There is no way we can preempt this. The only way is to react and respond towards it. And this is what we feel would be the right approach, that we plan that whatever money that we get, any new client who comes in, or any inflow that we see, we are gradually deploying over the next 2 to 3 months. We are not overnight deploying these funds anyway, and that's broadly what our market call is. We don't take cash calls, so we have not taken any cash call when the market was down in the month of Jan, Feb, March. We are not taking any cash calls even right now. It is just that the cash deployment is gradual. It's happening over a 2 to 3 month period instead of happening immediately in maybe a week or 10 days or 15 days time, which would be the case earlier. So that's broadly where we are. Just to conclude, on the valuations front, Indian markets are now, you can say, fairly priced. I'll not say that they are cheap. Indian markets were never cheap, but uh, because of this time correction, because of this markets being flattish, or you can say pound to point 1 year return is zero kind of a scenario. Plus, there has been earnings growth in the same time. The valuations, which used to be 10% premium, 10-12% premium to the 10-year average, are now back to the 10-year average, which you see on your screen, both on a PE basis or on a price to book basis. In both the scenarios, we are now closer to 10-year average, which to me is a fair valuation, right? So we are not cheap, we are not below the mean, but at the same time, the premium above the mean is also not there, and hence we are fairly priced. So from a fairly priced market, one should be expecting a fair return. And the fair return to us is somewhere in mid-teens kind of return, because that's what the earnings or the corporate earnings growth of India is, and that's what ultimately should get reflected in the stock market. So this is where we feel one should not look at equity markets as what it has done over the past 3-4 years. Those scenario was pretty different. We were coming off a low base. There was a strong re-rating which happened globally, including India, and hence PE multiples expanded, and you make those kind of returns. Those returns may or may not be possible in the near term. But the good thing is in equity market that it is still possible, may or may not. In that, may is also equally important as may not, right? It's a 50-50% share. Why it's possible? Because tomorrow, say for example, Modi and Trump have a good meeting, they have a good negotiation, and the tariff in India is lower than the competition, which we have saw a few months back. If that materializes, the Indian market will reach it. If the GST announcement which the government has done, it is true that 28 becomes 18 and many of the 18 goes to 5, then it's a clear indication that the consumption demand in India is going to pick up. This can also re-rate the markets. And if that happens, then the 10, 12, 15% expectation can go to 15, 18, 20, 22% kind of expectation for markets. Like 3 years back when we discussed, we never said the Indian markets can give you a 30% CAGR return, but it has. That's the beauty of equity markets. At least there's this option or there's this scope for the markets to re-rate or give you a better return than what we initially thought. But to our mind, our return expectation should be fair because it's a fairly priced market. If you expect 20% return and you get 15%, you're unhappy. You expect 12%, you make 15%, you're more than happy. The numbers remain the same, the performance is the same of 15%. It's just that how you feel or how do you have your expectations set from the market. So don't go by the past. Past numbers might not be sustainable, but still a double-digit return which is expected from equity market comes in. That's something which is among the better performing asset classes, and hence that's what our pitch on equity market is, that you will make a normal return, you will make a fair return, plus there's always this option that this return can be on the higher side if some positive material events come in. So that's broadly on the markets and how things look into India. Sectorally, if you ask me how the valuation stacked up, we are now more constructive on banks than what we were, say, a year back or 6 months back. Banks did see a decent rally in June, July. Half of the rally has been given away. And again, they are now back to where the normal valuations were, or the average valuations are. This is on your what you're on the screen on the left bottom. And hence now again, banking started to look interesting. Pharma has started to re-rate, and that is something which is also looking good to us. We are now neutral in IT. We have trimmed our exposure on IT because of the size, the growth rate that is struggling, and what we initially thought could be a big fill up in the kind of a tax break in US, and that money could come into IT spending. That seems to have got deferred, and hence we are no longer that positive in IT the way we were a few months back. Uh, on cap goods, also there has been some kind of, you can say, derating which has happened, which you see on the screen here. And this segment now looks good to us because the capex activity in India is still on a high. In fact, government capex, which was in a lull or was seeing a slowdown, is back in action as we speak, month on month since March or since April of this year. Every month, the order, the tendering activity, the execution, everything from the government side has picked up, and hence the capital goods, industrial companies, EPC companies are some of the companies that stand to be a natural beneficiary of this, and they should tend to do well. Metal and mining, we are neutral. It's more of a global sector, and unless and until there's a global tariff clarity, this sector is not going to meaningfully outperform. Though we have a positive view on this, but we have not significantly increased our exposure on this. Uh, This is some of the slides, some of the data as to highlight that the economy is doing well. You see that GST collection, the GST collection is not fairly represented here, but it's all inching up. The execution is also pretty good. The digital transactions, the energy consumption, most of the data points in India, the high frequency data points are all pointing out that things are looking good. Plus, we are headed towards a windfall gain of almost $44 billion, which can come in from the pay commission, which is due next year. And that is also something which can materially impact the growth prospects of the country. Coming to question as to how the government will be able to handle the GST tax cuts if it happens, or the rate cut if it happens, we feel the government will be able to handle it because the fiscal deficit is still under control and we have decent forex reserves, right? So a combination of these two factors makes us believe that the government can sustain a slightly higher fiscal deficit than what it initially wants. And even if there's a gradual decrease, people are not going to be too worried about it, and hence something this is manageable. So we are not too worried about how the government is going to fund the GST rate cut if that happens. Finally, coming on to the earnings front, this is where can say bulk of the queries or the worries stands in that economy is recovering, but the earnings growth is yet to recover. And what's the reason for that? I believe the reason for that is that many of the companies which are contributing to the recovery are in the MSME space, are in the unlisted space, and hence their growth is not getting captured into the corporate profile growth of the distant market space in India. Also, the distant market space, there are lots of seen new age companies, lots of digital companies, where the companies are doing well, great brands, great monopolies, but on a reported basis, they're still not making money, or many of them are still not making money. And that is also depressing the average earnings growth of Nifty, or for the matter, the broader markets. So when this trend can change, I think the 2Q numbers should be better than 1Q. So there should be an acceleration Q and Q, and 3Q and 4Q for sure is going to be better, simply because of the base effect. Last year, 3 and 4Q are not so great. So we have a favorable base effect, plus the momentum which is there in the economy should sustain, should continue, and that should bode well for the second half earnings numbers to come in. That's broadly what we feel should happen in the near term. So that's more or less what we had to share as far as the market update is concerned. To reiterate, we feel that the risk to the markets, if any, is more global than local. Locally, things are on the recovery path. The government is on full throttle, both government as well as the RBI, and they are pretty clear that the growth rate should pick up, and they will do whatever it needs to do. And we have already seen many of the actions coming in. Plus, the GST now is an additional kicker that has just got announced. So, net, Indian equity markets should do well. It might not give you a linear return because that's the nature of the equity market. But overall, if somebody has a 3 to 5 year view, we feel a mid-teen kind of a return is very much possible from Indian equities, plus an option of a further upside if things go well. So this is more so the slide on the risk, which I think we have already discussed. So I'll take a pause here. Maybe now we can open up for Q&A. I'm sure you guys would have some queries on the markets or overall any queries, except for stock specific discussions, which we can't do due to SEBI restrictions. Anything on the markets, we'll be happy to help. Shweta, we
Yes,
can
sir.
now open up for Q&A.
Okay, sorry. So one question. Considering the current market setup, your views on all our three PMS strategies.
So the three PMS strategies follow the same philosophy of value conscious investing, not overpaying, being growth focused, and trying to be ahead of the curve by being early investor into many companies. So that focus continues, and hence, whenever that style does well, all the funds should do well. In the near term, we feel the emerging portfolio could be more volatile than the others if the market turns to be volatile because it's a high beta, and till a few months back, mid caps were not doing so well. But in the last 2 months, they've also catched up. So now their valuations are back to where it was earlier, start of the year when the markets corrected in a way. Hence, if market were correct in the near term, the emerging portfolio will fall more than the other two portfolios. Otherwise, we are very comfortable on all the three strategies because it's not that we look at portfolios from a market cap criteria. For example, we never have this discussion that whether large caps will do well or mid caps will do well. So it's never a question of or. It's never large cap versus mid caps. So should I buy more large cap or should I buy more mid caps? At any given point of time, our focus is what makes sense within large caps, what is good relative valuation, what is the good absolute valuation, and what makes sense on the mid cap portfolio or on the mid cap segment, right? So it's never large cap versus mid caps. So whoever performs well, their contribution in the portfolio should contribute well, is what we feel. Yes, the contribution could be different because a mid cap, mid and small cap opportunities PMS is only mid and small cap. There is no large cap, and all cap has larger than mid cap, right? So if both do well, then all cap can do well in the near term. When mid caps do well, definitely opportunities will do well. So in the near term, it will be more safer or it will be less volatile. The both ADAF as well as the all cap strategy. Emerging can be more volatile, but eventually, if one has to invest with a 5 year view, then we feel the mid and small cap strategy can continue to deliver higher alpha over the other two strategies, which has been the case in the past also.
Okay. The next question is with respect to the June quarter results, are they in line with the estimates?
We are broadly in line with the estimates. Whatever estimates we had for our portfolio, most of the companies have reported numbers closer to what we have been seeing. For the markets, there has been a slight disappointment. Market was expecting slightly better growth rate, which has not happened. But that growth rate has not happened specific to certain sector. It's not a broad-based kind of disappointment for the market. So growth has picked up in that way, but it's yet to get reflected in the earnings. You can say reported earnings basis for the Nifty or for the market, and that should happen in the second half is what we feel. So net first Q was in line for us. Slight disappointment for the broader market in that sense.
Okay, the next question is it good to go with equity or gold investment in current situation view for or gold ETF for the next 2 to 3 year view?
We don't invest into gold. We don't have any exposure there, and hence I'm not the right person to comment on gold. All I can we do only equity markets, and in equity markets, I can tell you that I don't know about gold, so I can't compare with gold. But on an equity market perspective, as I mentioned, one should be expecting a fair return, so which is a mid-teen kind of a return from Indian markets over the next 3 to 5 years. So maybe in the near term it might happen, but eventually over this period of time, this is the kind of return one should be getting, which I believe in if the gold does well, this would be comparable, and hence we stay pretty positive on the equity as an asset class.
Okay. The next question is with a 3 year investment view, which are the three best sectors and three sectors to avoid?
So right now we are avoiding autos, we are avoiding IT, energy, oil and gas, and consumer sector. Consumer specifically because of high valuation. So these are the sectors that we are avoiding. We are positive on financials, we are positive on industrials, cap goods, pharma, chemicals. So these are the sectors that look good to us from a 1 to 3 year perspective.
Uh, yeah, the next question is emerging portfolio. Do you suggest a stagger approach? And what would be the PE valuation?
Not just for the emerging portfolio, we suggest staggering over the next 2 to 3 months for all the three portfolios that we have, because we feel markets could be volatile in the near term based on where the tariff number comes in, and one should be prepared to take advantage of that volatility or of that correction if it happens. So this is broadly the view, and hence because of this view, we suggest a staggered thing for all the three portfolio, not just for emerging. And that stagger is over the next 2 to 3 months, because whatever has to happen on the tariff front should be concluding over the next 2 to 3 months, because US also cannot afford too much of uncertainty. If they keep negotiations open for too long, then it's going to impact them also. So I believe they would also prefer to close this issue as soon as possible.
Okay. The next question is your view on banking sector.
The view is positive on banking, except for 2Q, where the margins could be under pressure, because whenever the rate cut happens, initially there's a margin pressure, and then the banks or the NBFCs or the other participants start to pass on completely the rate impact, and then the margin again improves. So uh, post 2Q, I expect the financial sector to outperform the broader markets, and that's the reason the outlook remains positive. No economy can grow without the banking sector participating. If there is economic growth, then people will borrow either for capex, either for working capital, for M&A, or for something else. Hence, in a growing economy, the credit growth will also pick up. So, since we're expecting economic growth to pick up, we are expecting the same for the credit growth, and that's the reason we have a positive view on the financial segment.
Okay. The next question is what's your view on Indian bond yields, 10 year bond yields, as its direction can cause valuation compression or expansion?
Sorry, we don't do bond investing, so we don't have a view, or you should not be taking my view on bond yields. From an equity standpoint, I don't think bond yields play a major role in Indian equity markets. It plays a major role in developed markets, because there people compare the dividend yield versus the bond yield or the cash flow yield of the market. India is a growth market. Stocks in India get valued on PEG or PE basis rather than on a yield basis, and hence uh, it's not that material a data point for equity markets as to where the bond yields are headed and the consequences impact of that on the equity markets. So it's limited in India. More so, it's prevalent in the global or in the developed markets per se. Hence, first, we don't have a view, and even if wherever the yield goes, positive or negative, if it is a smooth, gradual move, either ways, I believe equity markets won't be too worried.
Okay. The next question is considering the layoff zone, what is your view on IT sector?
As I mentioned, we have a neutral view on the IT. In the last 3 months, we have trimmed our exposure in IT to a small extent. This is happening because of the growth rates not picking up. Earlier, the expectation that Trump will come in within 2 to 3 months, he will announce a tax break, which will give more disposable income to the corporates, and they are going to spend that more on IT and more on getting digital ready, kind of a scenario. But that has not happened. It has got deferred, and hence the growth rate for IT market is also got deferred in that sense. Plus, we have larger companies which are too large now to grow meaningfully in a double-digit scenario, right? So if some companies are eventually going to grow at 5, 6, 7, 8%, then there's no point paying 25, 30p for those stocks, right? And hence there's always this risk of de-rating now in the IT sector. That's the reason we have a neutral view on IT.
Okay. Can we expect a bubble burst considering the Nifty valuations?
No, there is no bubble in Nifty valuation because, as I explained, and what you see on the screen, the valuations are now closer to what it was in a 10-year average. So it's not that we are in a out of proportion zone or too expensive, and it's a bubble which can burst. So at near average, there is no bubble as such in the valuation. There can be euphoria, there can be some pockets of exuberance, there could be some bubbles in certain limited stocks or certain limited sectors, but that's the story at any given point of time, whether it's a bull market or a bear market or whoever is handling the portfolio or the way market is behaving. There'll always be some stocks which are dirt cheap or which are stocks where there is low investor interest, and there'll always be some stocks or sectors where there's investor frenzy. And this also changes every 2 to 3 years. So there was a time when IT did well, then pharma did well. In fact, before the coal scam broke out, utility companies in India did well. A few years back, it was IPO, all the new age companies. Last year and a half, it has been defense, PSU names, railways. Maybe going ahead, there will be another sector rotation and some other sector will do well, right? So uh, I'm not too worried on the valuation front per se.
Okay. Sir, I think we have covered majorly all the questions. Any concluding remarks from your side?
Sure. Thanks everyone for joining us this evening. And before we wind up, just to reiterate that we stay constructive, we stay positive on Indian equities. Near term could be volatile, mainly because of global reasons, which nobody can predict, nobody can time, nobody can preempt. It's going to be an only reaction to what happens globally, and that is what everybody's waiting for. If the tariff scenario is in line, then the markets will rally. And if the number is higher than what the peer group number is, then there's a fair chance the markets will go back and maybe lose another 5, 10, 15% from the current highs that it has made. That's broadly what, in a nutshell, the view is. Overall, we should make a decent return on the markets. It's what we continue to believe on.
Okay, sir. Thank you. Thank you, everyone. We look forward to connecting with you all again next month. Thank you.
All investments are subject to market risks. Please read all scheme-related documents carefully before investing. Performance and references to returns are indicative and does not guarantee any returns. Investor discretion is advised. This video is neither a general offer nor solicitation to avail the service of investment from the CB registered intermediary under the services offered by Abacus, nor is it an offer to sell or generally solicit an offer to become an investor in the services offered by the Abacus. The delivery of this video at any time does not imply that information herein is correct as of any time subsequent to its date. The contents of this video are provisional and may be subject to change.